Good afternoon, morning, or evening, depending on where you're joining us. Thank you for joining us today for our nonprofit tax update. Looking forward to speaking with you today about the tax impacts that are affecting not-for-profit organizations. As a quick introduction, my name is Amanda Adams. I'm a tax partner with Citrin Cooperman Advisors. I also am the leader for the not-for-profit tax services for the firm. So I've been working in the exempt organization space for over 20 years, so I've seen a lot of changes since I first began, not only to the 990, but also sort of the key areas that are affecting nonprofits and exempt organizations. So let's dive into our agenda today. First, I want to talk about some legislative activity. There are a few things that have been introduced that have not necessarily gone anywhere, but there are a number of them that have potential to impact the sector. Also want to talk about the current state of the IRS. Each year, the Exempt Organization Division publishes a list of their accomplishments for the most recent fiscal year, as well as their priorities for the upcoming year. So it's always helpful to take a look at those things. Also, there's been some new guidance released over the last year that affects the nonprofit sector. So we're going to talk about those things, as well as just some other developments, cases, and other things that have come up over the year. If you have any questions, don't hesitate to enter them into the Q&A section. I have that open. I'll take a look. If time permits, I'll answer those as we go through. Otherwise, may save them to the end. So first off, I just want to kind of frame the context of what we're talking about. As of the end of fiscal year 2023, there were almost 2 million exempt organizations in the IRS database, 75% of which are 501c3s. The remaining 25% consist of other exempt organizations such as social clubs, business leagues. There are many other types of exempt organizations, although you can see that primarily charitable organizations make up the bulk of the sector. As of the end of fiscal year 2024, exempt organizations employed over 28% of the American workforce and controlled nearly $53 trillion in assets. So it's a very sizable industry that has a big connection to employees, individuals, as well as people that they may be serving as clients. Given the size of that industry, you would expect that there would be kind of a robust team at the IRS that would be providing oversight and enforcement of the tax laws affecting these organizations. But this actually only consisted of about 2,100 people as of the end of fiscal year 2024. And as we'll discuss, there have been impacts to the IRS in terms of reduction in force. So that number is likely much smaller today. So let's jump into some legislative activity. So the first proposed item has to do with foreign grant reporting. This was introduced in May of 2024 and proposed expanded reporting requirements for NFPs making grants to foreign entities. So those of you familiar with the Form 990 know that there already exists some reporting in the 990 for foreign grants. That reporting does not include identification of the name and address of the foreign recipient. And that is what this proposed legislation was seeking to introduce. It has not progressed. In the past, when this reporting was first introduced to the Form 990 expansion back in 2008, they left a place for it on the form but grayed it out. At that time, there were concerns that there could be blowback on organizations in certain countries if it was known that they were receiving support from U.S. entities. So there was a lot of pressure at that time to keep that information out of a publicly disclosable document. But as you can see, there's been a lot of recent legislation focused specifically on foreign activities. And so the tides have changed in terms of wanting more transparency around activity made by U.S. organizations with foreign organizations, whether it's funding coming from those foreign sources or to those foreign sources. The next proposed legislation, called the End Zuckerbucks Act, was also introduced in May of 2024. This is more in connection with concerns about the use of charitable dollars to influence elections. So, as you may be aware, 501c3s are absolutely prohibited from engaging in any political campaign activity or electioneering. But they are allowed to provide certain nonpartisan funding that promotes things like registering to vote, encouraging people to vote, things like that. Well, there was a big concern here that perhaps the recent elections had been improperly influenced using charitable money. And so there was a desire to prohibit 501c3 organizations from providing funding directly to the government for the purpose of administration of elections. Again, that this has not progressed anywhere, but it does kind of give you a sign as to the concerns of certain people. So going back to what I mentioned before about, a foreign connection, this particular bill has two components. The first component has to do with foreign funding transparency. And so this proposed requiring all exempt organizations that file a Form 990 to have to disclose certain information about funding received from those foreign sources. So the proposed information disclosure was the total in aggregate received from foreign nationals, and then the total in aggregate received from each country. And not only for them to have to disclose that information, but also for that information to be made available in a publicly searchable database. So there was some concern here about exempt organizations receiving funds from foreign sources and whether that could have an impact on their activities and agenda. The second portion of this proposed legislation kind of takes an opposite stance, which is in that it wants to protect the privacy of certain donors. So only domestic donors, American source donors, those they wanted to prohibit federal agencies from collecting information about those donors that was not required by other lawful provisions. So this also has not progressed, but it just shows, again, kind of a concern about foreign source income, but also a concern about the identity of donors and that information perhaps being made publicly available in an improper manner. HR 8314, identified as the No Foreign Election Interference Act. This proposed the imposition of penalties with respect to contributions to political action committees received from certain exempt organizations that also received contributions from foreign nationals. So again, there's a concern about influence over elections, influence by foreign persons who are contributing to exempt organizations. And again, this made it a little further than the others in that it was voted on, but it did not achieve the required majority, so it's sitting idle as well. HR 9495 was a topic of a lot of concern in the NFP community. It seems like it would be something that would be perfectly reasonable, right? On the one hand, it allows for the postponement of tax deadlines for U.S. nationals that are held hostage. It seems like that would be difficult to argue, that should definitely be implemented for those persons. But what caused a lot of concern was the proposal to terminate the exempt status of terrorist supporting organizations. And not because anyone necessarily thinks that terrorist supporting organizations should continue to qualify for exempt status. The issue is that we already have existing provisions in the law that do not allow for such organizations to qualify for exempt status, that require their exempt status to be revoked. The concern was that the way this legislation was worded, that organizations that were accused perhaps of being terrorist supporting organizations might not have the opportunity to defend themselves, that the revocation of potential terrorist organizations would be revoked without, proper due process. So this actually was approved by the House. It was sent to the Senate and it didn't really go anywhere. And we're getting ready to talk about the one big beautiful bill. And a portion of this was temporarily added to the House version, but did not end up being included in the final version. So seemed like it was going to be revived, but then ultimately it wasn't. Perhaps, the discussion around the fact that we already have existing law on this issue that should be sufficient to address it was ultimately won out. So the next thing I wanted to turn to is executive orders. So since President Trump began his latest term, he has issued many executive orders, and many of them have been targeting the NFP industry in certain areas. Now, these are things that exempt organizations do need to consider. These executive orders have sometimes named a specific organization, and in other cases, they have just targeted segments of the not-for-profit sector based on their programs and activities. For example, by reducing or canceling sources of funding, by terminating government programs on which nonprofits or their beneficiaries depend, by declaring certain activities to be illegal. They also have directed investigations into certain types of organizations or activities. And they also have reduced the workforce of certain agencies on which nonprofits depend. Some of these executive orders have been challenged as unconstitutional in federal district courts, but they have still had an impact on the not-for-profit community nevertheless. So we're going to touch on a couple of specific executive orders. The first is the one titled Ending Illegal Discrimination and Restoring Merit-Based Opportunity. So this executive order directed executive agencies to terminate all discriminatory and illegal preferences, mandates, policies, programs, activities, guidance, regulations, enforcement actions, consent orders, and requirements, and to enforce America's longstanding civil rights laws and to combat illegal private sector DEI preferences, mandates, policies, programs, and activities. This order rescinds prior executive orders going back to 1965 regarding equal opportunity and affirmative action in federal contracting. It provides that recipients of government contracts or grants cannot operate any program promoting DEI that violates applicable anti-discrimination laws. So many organizations that have specifically referred to DEI activities as part of their programs or their operations have been looking at the executive order, have been talking with attorneys, trying to determine whether their activities fall under what would be considered discriminatory and illegal under these standards, or if they're activities that would still be allowable. The second executive order is memorandum for the heads of executive departments and agencies. And it states that it is the policy of the administration to stop funding NGOs that undermine the national interest, and directs the heads of executive departments and agencies to review all funding that agencies provide to NGOs, requires agencies to align future funding decisions with the interests of the United States and with the goals and priorities of the administration as expressed in executive actions, as otherwise determined in the judgment of the heads of agencies and on the basis of applicable authorizing statutes, regulations, and terms. So many organizations, let's say in the immigration or environmental sector, have interpreted this as to be a concern of whether they would be entitled to any future funding from the government on which they might rely, or whether their activities will still be considered, consistent with public policy. So there are many organizations, that are sort of very concerned about how their operations and activities fit in with the new administration's priorities. Again, for those organizations that, have concerns about whether their activities are possibly in violation of any executive orders, should certainly consult with attorneys. Again, as I mentioned, there are many out there that are having these conversations with organizations in terms of, how to operate in this new dynamic. Another item of focus, which is not new, but is continuing, is in the exempt hospital space. In April of 2024, letter from 9 Democratic members of the House asked the IRS for new regulations and guidance to clarify and strengthen Section 501R. 501R is the provision that establishes certain requirements for exempt organizations operating a hospital facility. And their recommendations were to make financial assistance policies and applications more accessible and less complex, to prohibit the billing of gross charges to any patient, to ban harmful collections practices, and to basically instruct the sector that nonprofit hospitals are required to provide charity care commensurate with their financial resources and provide guidance on the level of charity care that exempt hospitals must provide. There's been a lot of discussion about how Schedule H of the Form 990 does not provide the information necessary for the IRS or the public to evaluate how hospitals are meeting the requirements of 501c3, how they're fulfilling a charitable purpose. So this has not gotten a lot of movement, although there has been a lot of discussion about exempt hospitals and how they're operating. But it'll be interesting to see if anything develops. It of course will depend on, the amount of energy going into other priorities, but it does seem like there has been a repeated discussion about exempt hospitals and how they're demonstrating that they continue to qualify for exempt status. So now I'd like to turn to the state of the IRS. So as you likely are aware, if you have seen anything in the news or work with the IRS directly, you know that it's facing a lot of challenges right now. It has recently undergone a lot of cuts to its workforce. In fact, an article I read just this week stated that the estimate is that the IRS workforce is down 25% from this time last year. So while the exempt organization community at the IRS is still focused on certain priorities, given the fact that they have less employees, there will be certain divisions that are prioritized over other divisions. So know that we're looking sort of back in time in the IRS tax exempt and government entity, TEGE group, what they reported about their changes and their hopes for the future. These things, of course, will now be impacted by, the cuts to the workforce, the cuts to funding. They face a number of challenges in implementing these, but what they had achieved over the recent year is that they had somewhat grown their workforce. The growth of the workforce included hiring about 800 new employees. They also had some updates to the strengthening of the systems that are used by the public to access taxpayer information. So one of those items is a website called TEOS, the Tax Exempt Organization Search. It's on the irs.gov website. And that website accesses a comprehensive list of data sets, tax forms. It has information that's easily, accessible and downloadable. So they definitely were focusing on trying to make that something that's easier to be accessed. They also focused on more collaborative examinations. So instead of just kind of operating in a silo, they've been trying to connect more with other divisions of the IRS, such as high net worth individuals and estate and gift tax, and trying to incorporate that as they proceed, using the knowledge from all the sources that may have interrelated information. So their program focus areas, these are their core areas. This has not really changed much over the last few years. What this means is this is just how they operate. How do they fulfill their mandate to educate and oversee the exempt organization sector? So the first area is compliance strategies, and these are issues that are approved by the tax-exempt government entity compliance governance board to identify, prioritize, and allocate resources within the tax-exempt and government entity filing population. So what this basically means is that they have identified certain areas that they think are the highest priority, where they can benefit the community the most by focusing on these certain areas. And so then they develop strategies around those specific areas that they have determined are the most critical. Data-driven approaches, this is an approach based on quantitative criteria used to identify high-risk areas of non-compliance. So that they can focus on issues with the greatest impact. So this is data from the 990, data from other filings. All of this data is processed and used to try to identify situations that may not only indicate a red flag, but a very an important flag that there would be a benefit for them investigating, not just a simple error. Referrals, claims, and other casework. This includes referrals of alleged noncompliance from both internal and external sources. It also includes claims for refunds, credits, or adjustments. Compliance contacts. This is basically correspondence from the IRS out to taxpayers, also known as a compliance check. Basically, it's kind of like a, hey, we think, you might not be compliant in this particular area. Did you know these are the rules that you're supposed to follow? So these are not really like an examination where they might be seeking to collect additional tax or to revoke exempt status. It's just, by the way, did you know about this requirement? We want to make sure that you're aware and know that you need to take care of this. Determinations, that's the section that handles letters issued to exempt organizations on exempt status, private foundation classification, and other determinations. Voluntary compliance and other technical programs. It's mainly focused on voluntary correction for exempt retirement plans. For example, if they have had a plan failure, this allows for them to make a correction and get IRS approval that everything is okay. And then there are other technical programs that including knowledge management, where they're trying to make sure that they are maintaining a database of relevant information regarding items that their agents would need to know about, prior technical positions, tax technical analysis, making all of this available to employees, which is especially important as they get new employees, to be sure that this knowledge is passed down to new employees joining, and just making sure that the knowledge base of this section at the IRS is documented and maintained. So let's take a look at the EO examinations in fiscal year 2024. There were only about 3,200 examinations that were started during the year. And remember, way back in the beginning, I mentioned that we have an exempt organization database of almost 2 million organizations. So you can tell it's a very, very low percentage of examinations. And of those, only about 2,000 examinations were closed. Now, those examinations were apparently of the right organizations in that 75% of those examinations resulted in a tax change. So there was some sort of issue that was identified correctly to initiate the examination. 38% of these were picked up from a related examination. So that could mean that maybe an individual was being looked at for a transaction, and it turned out that there was some transaction with an exempt organization. So it could have been somehow connected to another entity or individual. And of those examinations, only 87 entities were recommended to have their exempt status revoked. So in my mind, I see that as, you know, the way that I've always viewed IRS examinations is that there is a focus generally on correcting mistakes, educating the organization, and that typically as long as the organization is willing to, you know, correct any errors it may have had, that exempt status is going to remain. So in those revocations, the common issues were failure to meet the organizational and operational tests. So what that means is their organizing documents may not have limited their activities to only those activities that allow for exempt status, or it could be that they were not operating for exempt purposes, which can also include organizations that are dormant. So it's important to remember that to operate exclusively for exempt purposes, you have to have operations. So sometimes organizations have their exempt status revoked for that reason. Not that they're doing anything wrong, they just aren't doing anything at all. And then, of course, as we hopefully know, organizations that fail to file their Form 990 for 3 consecutive years will automatically have their exempt status revoked. So that can also be a prompt for having the exempt status revoked. So the compliance strategies that the IRS was focused on in fiscal year 2024, number one was Form 990N filing eligibility. So the Form 990N is for the small organizations whose gross receipts are normally less than $50,000. So the IRS was using data from other sources such as 1099s and things like that to determine organizations that they thought perhaps might have had gross receipts over that threshold, but we're filing 990N. So it's important to remember that the 990N is not it's not a return in the sense of a 990EZ or 990 or 990PF being a return. It's an e-postcard. So if an organization was filing 990N, but they really should have been filing one of those other forms, then the filing of the 990N does not count as a return for purposes of the requirement to file a return for 3 consecutive years and not have your exempt status being revoked. Hospital organizations' compliance with 501R continued to be a compliance strategy. Most prominent issues found in these compliance strategy exams related to filing and operational requirements. This was only about 5% of examinations started during the year. Data-driven examinations. These were organizations that were selected through data queries based on information reported in the 990EZ and 990. This focused heavily on private benefit and enrollment. So it was looking at organizations that their returns had indicators of potential private benefit. With respect to private foundations, they were looking at loans between private foundations and disqualified persons in particular. And this section represented about 15% of examinations started during the year. So it probably will not come as a surprise to you that the referrals, claims, and other coursework represented about 80% of examinations started during the year. The IRS has historically had a lot of its examinations come from referrals. That just has been a primary source of information. We also had in the other coursework section the continuation of organizations claiming the employee retention credit. And so there were examinations relating to that. In some cases, when they were analyzing the employee retention credit claims, they were finding that there were organizations that were not eligible for that credit. And so there were some that kind of got engaged in that by, there were a lot of providers out there that were really pushing the employee retention credit as a viable option, but it may not have been for certain organizations. So moving to determinations, this is typically where organizations are applying for exempt status. There were a whopping 136,000 determination applications closed during the fiscal year, with 128,000 approximately of those being approvals for 501c3 status. So the interesting aspect here is you can see that over in the graph over the past 4 years, the Form 1023-EZ has been the primary application mode for exempt status. Similar to the 990-EZ, the 1023-EZ is for small organizations. There's a number of other criteria. They can't be, carrying on certain activities. There's a very, very long list of eligibility criteria. It is a good option for smaller organizations that don't have complex activity. But again, one should be very sure that you meet the eligibility requirements before using the 1023-EZ. Government entities also had their own compliance strategies. These were mostly focused on worker classification. Again, in the data-driven examination, similar thing, employee classification, taxable fringe benefits, unreported compensation, and backup withholding. For all exempt organizations, this is a kind of a hot area that the IRS typically looks at in connection with anything, is just making sure that employers are properly classifying their workers. Tax exempt bonds, in that sector, compliance strategies, we're looking at arbitrage violations, yield restrictions, certain requirements for small issue bonds. So there were other issues in the referrals and claims section where there was a sale or disposition of the underlying property that perhaps resulted in a violation, or there was a management contract in connection with the exempt bond finance property that resulted in private use. So not many examinations in this area, but for those organizations that have tax exempt financing, it's always important to make sure you're remaining in compliance. So compliance checks during the year included discrepancies in payroll filings, looking at exempt organizations that failed to file certain forms where information indicated that those forms were required, entities that have credit balances but didn't file tax returns. Again, it's just places where there are inconsistencies, where one piece of information is indicating something and it's not matching up on the other side. They send out educational contacts to let organizations know there might be an error or missed filing. There were only 877 reviews of tax exempt hospitals. So there are reviews each year, but this was below the yearly average due to resource limitations. I'm sure that's going to continue. But the intention is for all exempt hospitals to be, reviewed on a regular basis to be sure that they're in compliance with 501(r). So TEG's priorities for fiscal year 2025, again, these main categories have not really changed over the last few years. They're basically looking at a better taxpayer experience. Wouldn't that be great? It's hard to know if that will be achievable given, reductions in workforce. What I've heard is that they're still going to place a high priority on the determination section, making sure those exemption applications get approved quickly. Where we may see issues is on the processing of correspondence, such as when you have a late filing penalty notice and you write to the IRS to demonstrate what your reasonable cause is. Those are taking quite a bit of time to be processed. I think the phones are still being answered fairly quickly. I know at the beginning of the pandemic, it was like much worse than it is today. So hopefully that will continue. The only issue I've run into from time to time is the person that picks up may not be able to help you with your particular issue. They may have They may not have access to the proper software, and that kind of thing. But it is still nice to have someone pick up the phone rather than just getting "we're too busy to accept your call today" kind of a message. Faster issue resolution, again, we know that's a priority. That's looking at that correspondence, getting it addressed in a timely manner. The issue is, for many organizations, is they may have to pay tax practitioners to assist with these issues. And so the more time we have to spend, the more it costs them to get something resolved. Advanced technology and analytics, way back when the IRS was granted a big sum of money, the hope was that they were going to be able to use that to modernize their systems, which are very, very old. In fact, in reading the background of this advanced technology and analytics, apparently they still have data on microfiche. They have software programs that use a language that nobody in today's technology area even knows. It's so old. So the hope was that they would be able to get all their systems properly modernized and up and working. But again, with the budget cuts and cuts to the workforce, it remains to be seen how much progress they'll make on that. So the priority guidance plan, this comes out every year. This is kind of like a running list of the top items that need further guidance from the IRS, either in the form of proposed regulations or a notice, some sort of guidance from the IRS providing some instruction. One of the big things that has been a pain to the sector is the guidance revising Revenue Procedure 80-27 regarding group exemption letters. So the processing of a request for a group exemption letter is on hold until this guidance comes out. So basically that means that no one can newly create a group exemption. So that is causing some challenges, as that was a very helpful available feature for parent organizations that might be facilitating the creation of a number of chapters. This way they wouldn't have each chapter have to apply for exempt status. They could all be covered under this group exemption. Another key item that has been on the list for a while has to do with the allocation of expenses in computing unrelated business taxable income, and addressing how the changes made to the net operating loss deduction apply for purposes of the requirement that UBTI be tracked by separate trade or business. Another one that's been on there for a while has to do with when a private foundation makes an investment in a partnership in which disqualified persons are also partners. There's always been a question as to whether or how self-dealing could possibly occur in such a situation. We're also looking for final regulations under sections 4966 pertaining to donor advised funds, and even some proposed regulations under section 4967. The issue with some of these items is that what happens is when there's new legislation, that has a higher priority in terms of getting guidance out. So sometimes things linger. If they don't seem to need immediate guidance, they kind of get put on the back burner, which is how a number of these items have been lingering for a while. So we'll see. Again, I'm sure many of these things may have already been started, but depending on where they are in the process, it may take some additional time to get them to the next step. So let's turn a little to some new guidance that we had, that we did receive during the year. One of those was the obsolestion of Revenue Procedure 82-2 and Revenue Ruling 75-38. So 501c3 organizations are generally required to state in their organizing document that upon dissolution, they will distribute their assets to qualified organizations for 501c3 purposes. If they did not officially state that in their organizing documents, they were allowed to meet that requirement by operation of state law. If the state in which they were formed had that provision automatically, unless the organizing document stated something to the contrary. So that revenue procedure identified the states. Obviously, it made sense. It's been quite a long time since 1982. Laws may have changed. And so what they did is issue Technical Advice Memorandum 2024-02, which has an updated chart that lists out the states which have laws that satisfy this requirement, broken out by the different entity types and how they may have been formed. So I think that's very helpful for practitioners and others. Again, best practice would be to include it in the organizing document, but in the event that it isn't, we have this other provision that can help. Also, proposed regulations pertaining to the corporate alternative minimum tax were issued. This is not of an impact to a lot of exempt organizations. Some of the larger exempt organizations could potentially have an impact here, but generally speaking, this corporate alternative minimum tax would not affect an exempt organization unless it had an average annual adjusted financial statement, unrelated business income exceeding $1 billion. So that's not going to be most of the organizations in this section, but for the larger organizations that had to aggregate a number of entities where it's possible, that they could be over that threshold, the proposed regulations provide some definitions and clarity around that. The IRS did also explicitly state that Form 4626 was not required to be filed by exempt organizations for 2023. That would normally be attached to the 990T. Basically, for organizations that meet the simplified method to determine they're not subject to the tax, do not need to file the form. But for others, they might have to demonstrate some calculations on the form and include it with their return. Notice 2025-2027 was recently issued, and it provides some interim guidance and an interim simplified method. Another thing that came out a little bit late, but was also helpful, has to do with organizations that were wanting to make an elective payment election on the Form 990T for certain tax credits, such as the clean energy tax credit. There was a concern that if they had not filed an extension for the Form 990T, then they would not be properly filing a timely filed return to claim the credit, and therefore might not be eligible for the credit. So the IRS came out with this revenue procedure that said that they would be granted an automatic extension, regardless of whether they filed an extension. And then it also provided an exception to having to electronically file the 990T only for those making the elective payment election, because there were some that were running into trouble with all of the tax credit support that needed to be attached to it. And so if certain procedures are followed, those organizations can paper file the 990T, and the above relief applies to tax years ending 12/31/23 to November 30, 2024. Revenue Procedure 2025-5 provided a couple of updates that are important to note. One is that the excise tax on excess benefits will continue to apply to organizations that were initially qualified as a public charity, but then convert to another 501c type status. So there was some communication from the IRS about the process if an organization wanted to convert from 501c3 to another 501c status. And this was kind of their main concern around that, was trying to prevent an avoidance of this excise tax on excess benefits by virtue of changing from a type of organization that would be subject to that tax versus one that would not. Also added 4 new categories of organizations that are not permitted to use Form 1023-EZ to request exempt status. That includes organizations that have previously received a ruling denying exempt status, organizations that have previously been determined ineligible to file the 1023-EZ. Interestingly, organizations conducting activities involving controlled substances, and organizations engaged in exchanging, creating, or distributing digital assets. For items 3 and 4, surely it's because they want more in-depth information. A full Form 1023 would require that information to be provided. The 1023-EZ is fairly limited. So let's just touch base quickly on a few other developments. There was a Tax Foundation article that came out recently that was very interesting. It offered a different perspective on the exempt organization sector, basically suggesting that a lot of a big majority of the sector now receives a lot of income from not from contributions, but from business-like activities, whether that's program service revenue or investment income. And basically, this article proposes that, the tax base could be better broadened by taxing, taxing that revenue rather than having the unrelated business income tax regime. Just anything that's not a contribution should be taxed. And increasing, the requirements for public support calculations. It doesn't seem like any of this has factored into any of the proposed legislation I've seen, but I just thought it was interesting look at the sector. This development in Minnesota is always important to remember that while we have the IRS on one hand, who is sort of monitoring the exempt status at a federal level, we also have the charity officials at the state level who have the responsibility and to make sure that organizations operating in their state are in compliance with requirements. And so the Attorney General is another area where they might be looking at, how is the charity operating? Is it operating in a deceptive manner? Is it misusing charitable funds? In this case, there was an individual who had engaged in a deceptive pattern of behavior by either creating or taking over not-for-profit organizations that had names that sounded like governmental entities, and he was using the confusion that would come from those similar sounding names basically to generate profits for himself. So the not-for-profits involved were dissolved, they didn't meet minimum requirements, and that individual is now banned from incorporating or leading nonprofits in that state. So here again, it's no surprise we have, TIGTA is regularly recommending, evaluating and recommending improvements to how the IRS and other portions of the government are operating. Here, their research indicated that those individuals who are in the compliance check section were not operating as efficiently as they were just 3 years prior, that they were not necessarily following the right operating procedures. Again, it seemed like an extremely inefficient process. Again, it's hard to say how things may change. I know that when we have less people, there is a lot more pressure to be more efficient. But again, the people have to have the training and the ability to do the work. So we'll see if any improvements are generated. I mentioned before how the IRS has had issues with their technology. They had recently, communicated a lot of progress in modernizing their technology, but they did officially state that they were going to have to pause that work. Again, they have spent quite a bit of money so far on contractors, but the modernization process does need to take into account reduced budgets, reduced staffing. They're also looking at how they may incorporate AI into their processes, including the examination process. So I know that's certainly not a new idea. Many industries, employers, companies are looking at how they can use AI in their processes, but it seems like quite a big jump from the old technology they have to incorporating that. So I think that could be challenging. We have just a couple minutes left. So there was one last thing I did want to mention, which is that, before I mentioned about how worker classification issues can, or continue to be a challenge for exempt organizations. And so here was sort of a positive one for this particular employee, because in this case, the IRS had assessed an almost $300,000 penalty against the CFO for failing to deposit employment taxes withheld from its employees. And fortunately, in this instance, he was able to demonstrate that he was not a responsible person because he was not authorized to write checks on his own, that all checks required two signatures, and so he was not the sole determiner of whether those items were paid or not paid. Unfortunately, he had to actually pay the penalty and then request a refund in order to be able to get that result. But I want to thank everybody for your time today. If anything comes up, please don't hesitate to reach out if you had a question but didn't ask it, or if you think of something later, we would love to hear from you. Thanks again for your time today. Have a great day.